Imagine this, just picture it for a second. The massive 20-foot moving truck is just idling right there in your driveway.
Oh man, the ultimate nightmare scenario.
Right. I mean, your entire life, every dish, every photograph, every piece of clothing is already packed up into cardboard boxes. You've got the kids buckled in the car, and you are totally ready to head to the title office to finally get the keys to your new home.
Yep, the finish line.
Exactly. And then, out of nowhere, your phone rings, and it's the bank.
And it is never a good call on moving day.
Ever. They are halting the closing entirely. You aren't getting the keys today. And why? Because, well, you deposited $50 into your checking account 3 days ago, and some automated compliance system flagged it as unverified income.
Which sounds completely wild, right?
Mm-hmm.
But it actually represents a completely normal Tuesday in the complex machinery of the American housing market.
Yeah, it really does. And whether you are a prospective homebuyer getting ready to take the plunge, or maybe a seasoned real estate investor looking to expand your portfolio, or just someone listening who is intensely curious about the invisible financial gears turning quietly in your own neighborhood, this deep dive is built specifically for you.
We're basically going to map out the whole labyrinth.
Right. The deeply frustrating, highly bureaucratic, yet completely fascinating labyrinth of buying a home.
And to do that, we are looking at the everyday realities of a single local lender.
Yeah.
We're using a company called Ace Mortgage Loan Corp as our microcosm to understand the macro economy.
Yeah. Ace Mortgage has been operating out of Coral Springs, Florida since 1996. And for the detail-oriented folks listening, their verified NMLS number is 223-104, which, by the way, isn't just some random serial number, right?
No, not at all. The NMLS, a nationwide multi-state licensing system, is essentially a federal fingerprint for lenders and brokers. It ensures they are strictly regulated and tracked.
It's basically the first sign that when you step into real estate, you are stepping into a highly, highly monitored space.
Yeah, exactly. But what makes studying this particular Coral Springs company so compelling is just the sheer variety of records we're looking at today.
We've got a lot to go through.
We really do. We have their standard corporate loan menus, an incredibly passionate trove of client reviews, and several remarkably blunt blog posts written by the owner of the company, Scott Osher.
Oh, Osher does not pull his punches in these posts at all. It's this brilliant mix of high-level economic theory and the incredibly visceral, micro-level human experience of moving into a house.
Yeah, it's a great read.
So to understand how these two worlds collide, we have to start right at the starting line of the homeownership journey, which is the loan menu. Because before you can even worry about moving trucks, you are faced with this overwhelming list of financial vehicles. You just have to know which one will actually get you to the finish line.
Right, and if we look at the offerings from Ace Mortgage, we can decode the major pillars of that menu. For a lot of people, the default is what we call a conventional loan.
Okay.
These are the mortgages backed by Fannie Mae and Freddie Mac.
Now, I hear those names constantly on the financial news, but let's actually explain what they mean for the person listening, because Fannie Mae and Freddie Mac aren't like local banks sitting on a street corner handing out cash, right?
Not at all. They are government-sponsored enterprises, or GSEs. You can think of them as a massive, invisible recycling plant for the mortgage industry.
A recycling plant.
Yeah, so when a local lender in Coral Springs gives you a conventional loan, they don't want to just sit around and wait 30 years for you to pay them back.
Right, that ties up all their money.
Exactly.
Yeah.
They want their cash back immediately so they can go lend it to the next family. So Fannie Mae and Freddie Mac swoop in and buy that mortgage from the local lender.
Okay, I get that.
But, and this is the crucial part here, they will only buy it if you, that borrower, meet their incredibly strict standards for credit and income.
So conventional loans are widely available, but to get the best interest rates, your financial history basically has to be absolutely pristine.
Spot on.
But what if it isn't? Or, what if you are a first-time buyer who hasn't had a full decade to save up some massive down payment?
Well, that is exactly where the Federal Housing Administration, the FHA, steps in.
Okay.
Ace Mortgage's documents highlight that FHA loans allow for 96.5% financing.
Wait, really? So you only need to bring a 3.5% down payment to the table?
That's it, just 3.5%.
And
And they are much more forgiving of past credit mistakes, too.
Wow. And then you also have specialized pathways, right? Like VA loans for veterans and active military personnel?
Yes, those offer 100% financing, literally zero down payment required, and there's no private mortgage insurance at all.
That's a huge benefit. And then on the complete opposite side of the financial spectrum, the menu offers jumbo loans.
The big ones.
Yeah, the documents describe these as private equity or portfolio loans meant for luxury properties. And interestingly, they specifically note that jumbo loans offer, quote, credit score flexibility.
And that flexibility exists entirely because of where the loan actually lives. A jumbo loan is for a house that is simply too expensive for Fannie Mae or Freddie Mac to legally buy.
Because they have caps on what they'll cover.
Exactly. So the bank or the private equity firm has to keep that massive loan on their own books, their own portfolio.
Oh, I see.
Because they're keeping the risk in-house, they don't have to follow those strict government formulas. They can look at your whole financial picture. If your credit score is slightly lower, but you have millions in liquid assets, the bank can just use its own common sense and say yes.
Okay, let me try to summarize this. If I'm thinking about this like renting a vehicle for a cross-country road trip, the VA loan is like a free all-access VIP luxury RV pass, but you only get it if you've served in the military. The conventional loan is your standard, reliable, mid-size sedan. It gets great mileage, but the rental company is going to run a super thorough background check on your driving record before they hand over those keys.
The analogy works perfectly.
Yeah.
So what about the FHA loan then?
Well, the FHA loan is a sturdy starter car. It gets you on the road when you just don't have a lot of cash up front. But because the dealer is taking a much bigger chance on you, they make you pay for some heavy-duty premium insurance along the way, just in case you crash it.
Yeah, that's a brilliant way to look at it.
But let me push back on this whole menu concept for a second.
Sure.
If government-backed loans like the FHA and VA offer such incredibly low barriers to entry, like 0 or 3.5% down, why on earth would anyone ever choose a conventional loan? Why wouldn't every single civilian just use an FHA loan? Is there a catch we're missing here?
Well, what's fascinating here is that the catch isn't a trick. It's actually a structural necessity to prevent the banking system from collapsing. Yeah. These different options exist specifically to segment risk. Think about the underlying mechanics of lending. A bank is handing over hundreds of thousands of dollars to a complete stranger.
Right, which is pretty terrifying if you think about it.
It is. If they treated every single borrower with a one-size-fits-all approach, say, demanding a strict 20% down payment from everyone across the board, they would completely freeze millions of middle-class Americans out of the housing market entirely.
Which means the banks wouldn't be making any money either.
Precisely. It's bad for everyone.
Yeah.
So, to keep capital flowing, the government steps in with the FHA. The local lender is perfectly happy to offer you 96.5% financing, because if you stop paying your mortgage, the Federal Housing Administration legally steps in and covers the lender's loss.
Ah, okay. But the catch for the buyer.
The catch for you, the consumer, is that to fund that massive national safety net, you're required to pay a monthly mortgage insurance premium, and sometimes you're paying that for the entire life of the loan. Yeah. With a conventional loan, you put more money down up front, and your pristine credit score acts as the safety net, which means you don't have to pay that expensive extra insurance. The whole menu exists because human financial profiles are incredibly diverse, and lenders need calculated pathways to approve loans without risking their own bankruptcy.
Okay, so now that we know how lenders segment risk to figure out what type of loan vehicle you're driving, that naturally raises the next obvious question.
How much is it going to cost?
Exactly. How much are they going to charge you for the privilege of driving it? And that leads us directly to what might be the single biggest misconception in the entire world of real estate: the interest rate.
Oh man, this is where Scott Osher's articles get aggressively candid.
Oh, absolutely. I mean, he has this article titled, "But My Neighbor Got," and he writes about how buyers constantly march into his Coral Springs office demanding the exact same low interest rate their neighbor just bragged about at a weekend barbecue.
We see that all the time in the industry.
And Osher's response is essentially, no, they didn't. Really, they didn't. He explicitly states that bankers and brokers do not make interest rates. Besides the broad macroeconomics set by the Federal Reserve, the individual is the one who makes the rate.
And that is a profound and, frankly, uncomfortable shift in perspective for a lot of buyers. It moves the responsibility completely away from the institution and places it squarely on the shoulders of the borrower.
Okay, let's unpack this. We constantly treat interest rates like they are prices on a diner menu. You walk into a diner, you order a burger, the burger is $10. It doesn't matter if you are a CEO or a broke college student, the burger is $10.
Right.
But Osher is saying a mortgage rate isn't a menu price at all. It's actually a financial report card.
Yeah.
You are getting graded in real time, and the hard truth is your neighbor just had a better financial GPA than you.
The diner menu analogy hits the nail right on the head. The macroeconomic environment, things like global bond markets and inflation, those dictate the baseline cost of money. That dictates the cost of the beef, so to speak.
Okay.
But you, the individual, control all your own variables on top of that baseline. Your history of paying bills on time, your credit card utilization, your employment stability, that's all on you.
And if you're listening to this right now and feeling a bit overwhelmed because maybe your credit isn't totally spotless, there's this incredible story in the Ace Mortgage Reviews that shows exactly how this works in practice.
Yes, the Amanda Monks review.
Exactly. A client named Amanda Monks left a review explicitly stating she had, quote, downright horrible credit. She does not sugarcoat it.
No, she was completely locked out of the market.
Right. She had been turned down by other brokers because her score was just too low. If rates were just diner menu prices, the bank was simply telling her she couldn't come inside the restaurant at all.
Yeah, they wouldn't even see her.
But she goes to Ace Mortgage and connects with a loan officer named Kelly. And Kelly doesn't just look at the low score and say no. According to Amanda, Kelly rolled up her sleeves and acted almost like a financial mechanic. She guided Amanda through a highly specific step-by-step credit repair plan.
Because a credit score isn't magic. It's just a mathematical formula.
Exactly. They actively worked to pull specific levers, maybe paying down a revolving credit card balance to lower her utilization rate, or disputing some old erroneous medical charge. They diagnosed the flaws in her report card, studied for the retake, and once her score hit the exact numerical target required, Amanda got a full pre-approval just 24 hours later.
Amanda's story is so vital because it completely demystifies the whole mechanism of lending. It proves that an interest rate isn't something you just passively shop for, hoping to stumble upon a weekend sale.
Right.
It is a reflection of risk that you actively build. The broker's job isn't to pull a 2% rate out of thin air. Their job is to be that diagnostic mechanic, showing you exactly which debts to pay down to manipulate the algorithm in your favor.
It is incredibly empowering when you look at it that way. You aren't just at the mercy of the bank. You have actual levers you can pull right now to change your financial destiny.
Ah.
But let's say you do everything right. You pick your loan type, you repair your credit, you get your interest rate locked in, and your boxes are finally packed. Well, you just enter a whole new phase of complexity.
The final hurdle.
Because this is the exact moment where your micro-level, highly personal journey violently crashes into massive macro-level bureaucracy.
Right, the friction at the finish line.
It is so visceral when you read Osher's materials on this. He has another article titled, "Are We Closing Tomorrow?" And this brings us right back to that terrifying scenario we talked about at the start of the deep dive. The moving truck is literally in your driveway.
And the call comes in that your closing has been delayed.
Osher describes the reaction as dead silence followed by internal rage. You were standing there asking, how did this happen? Who is responsible for this? And Osher points the finger directly at massive regulatory guardrails. Specifically, he mentions the Consumer Financial Protection Bureau, the CFPB, and an ominous regulatory push to eliminate something called the GSE patch.
This is where the underlying tension in the American financial system becomes incredibly stark.
But I need to stop and push back on this, though.
Go for it.
Because Consumer Financial Protection Bureau sounds like the good guys. Protection is literally right there in the name. How can consumer protection be the exact thing causing a family to be homeless with a moving truck idling in their driveway?
Well, if we connect this to the bigger picture, you really have to look at the history of why these incredibly strict guardrails exist in the first place. The CFPB was born out of the ashes of the 2008 housing crash.
Okay, that makes sense.
So we are looking at a fundamental, inescapable tension between systemic safety and individual speed.
Break that down for me a bit more.
Sure. So during the subprime mortgage crisis, lenders were just handing out loans to people with no verified income. When those loans defaulted on a massive scale, the entire global economy nearly collapsed.
It was a disaster.
It really was. So the CFPB created intense, sweeping regulations. They mandate that banks verify your income down to the penny multiple times throughout the process. They enforce strict waiting periods for closing disclosures so you can't be surprised by hidden fees at the signing table. These rules are designed to protect you from predatory lending and, honestly, to protect the economy from another collapse.
So it's all about long-term safety.
Yeah.
But in the short term.
In the short term, that safety manifests as absolute administrative gridlock.
Wow.
Yeah. If your bank statement shows a weird $50 deposit from a friend paying you back for dinner 2 days before closing, the compliance software doesn't know it's for dinner. It thinks you took out an undisclosed secret loan. And the regulatory system automatically throws the emergency brake.
That is maddening. And what about this GSE patch that Osher warns will have a tremendous effect on a consumer's ability to purchase? What actually is that?
Right. So remember earlier when we talked about GSE's Fannie Mae and Freddie Mac?
The recycling plans.
Exactly. Yeah. Well, the CSPB created a strict rule that says nobody should get a mortgage if their total monthly debts eat up more than 43% of their income. Just a hard line in the sand.
Okay.
But they realized pretty quickly that rule would lock out millions of responsible buyers. So they created a temporary patch and exemption. They basically said, if Fannie Mae's advanced automated software says the loan is safe, you can bypass that 43% cutoff.
Oh, I see.
So limiting that patch means removing the safety net entirely. It forces lenders back to a rigid, unbending mathematical cutoff.
So the entire system is just a minefield. I mean, we have moving day delays triggered by $50 deposits. We have incredibly strict credit algorithms dictating your interest rate. We have federal bureaus constantly changing the rules and threatening to remove loopholes like the GSE patch. How does an ordinary person, someone who isn't a financial expert who just wants a backyard for their kids, how do they actually survive this process? Because clearly millions of people do buy houses every year.
They do. And when you look closely at what Ace Mortgage is actually doing on the ground with their clients, you find the only known antidote to all of this dense federal bureaucracy.
And that antidote is relentless, localized hustle. It's the human element. You look at the reviews for this Coral Springs office, and the contrast between the cold federal regulations and the deeply personal local effort is just jarring.
It really is the defining characteristic of their success.
Take Miriam, for example. She's a Florida teacher. The company didn't just shove her into a standard loan. They helped her utilize something called the Hometown Hero Grant. Now, that grant provides crucial down payment assistance for frontline community workers in Florida. But using a government grant means injecting an entirely new, massive layer of state-level paperwork on top of the federal paperwork we just talked about.
Yeah, you absolutely need a navigator for that.
Exactly. And then look at Kelly Ardito's team. Another reviewer, Raquel Maldonado, noted that Kelly was actively answering her panic texts on nights and weekends. And let's go back to Amanda Monks, the buyer with the bad credit. She literally wrote that Kelly, quote, dragged the title agent to the finish line.
Dragged. I love that word choice. It implies sheer physical willpower against an immovable object.
Right. And Ace Mortgage's promotional materials explicitly state they make themselves available from 9 a.m. to 9 p.m. or even 24 hours a day, 7 days a week. They are working drastically outside normal banking hours because, well, in this regulatory environment, it is a strict necessity.
And this raises a really important point about what a modern loan officer actually does. A mortgage, at its core, is a massive, high-stakes translation job.
A translation job.
Yeah. The consumer is staring at a dense, terrifying foreign language. We see this in the reviews from clients like Alexander Eric and Anderson Alves. Both of them explicitly noted that they did a huge amount of independent research before even trying to refinance.
So they tried to navigate the labyrinth themselves first.
They tried. But even with internet research, the sheer volume of compliance rules, local grants, and risk segmentation is just paralyzing. They needed an expert.
Yeah.
The true value of a local mortgage company isn't just that they have access to the capital. The capital is everywhere. Fannie Mae ensures that. The real value is possessing the localized knowledge to find the Hometown Hero Grant and acting as a bureaucratic hacker.
A hacker. I like that.
You need someone with the sheer willpower to force a rigid, digitized compliance machine to recognize the humanity of an individual family.
They really are the translators. I mean, you can read all the textbooks you want about federal financial law, but when the automated software throws an emergency brake on a Friday afternoon and your moving truck is idling out front, you need someone who knows exactly which back door to use to fix it.
And crucially, someone who is actually willing to answer the phone to fix it at 8 p.m. on a Saturday. That level of intense personal dedication is the only bridge between the macro rules of the CFPB and the reality of getting the keys to your house.
So what does this all mean for you? We've unpacked a massive amount of invisible machinery today. We started by decoding the complex menu of financial vehicles, from FHA starter cars to jumbo portfolio loans.
Right.
We shattered the myth of the universal diner menu interest rate, discovering that you actually have the power to build your own rate by manipulating the levers of your financial report card. We explored the visceral frustration of closing day, where the very regulations designed to protect our economy can suddenly bring your life to a screeching halt.
And finally, we saw that the only real way to survive that labyrinth of red tape is the relentless weekend hustle of local translators willing to drag the paperwork to the finish line, which really leaves us with a fascinating dynamic to consider moving forward.
Oh.
Yeah. We live in an increasingly digitized era, right? We expect an algorithm to approve our purchases with one simple click. Yet as we've seen, the massive trillion-dollar mortgage sector remains shockingly dependent on human emotion, late-night text messages, and sheer willpower. As artificial intelligence and automated underwriting continue to streamline global finance, will the human Kellys of the world eventually become completely obsolete? Or will the immense emotional and bureaucratic weight of taking on a 30-year debt make that human translator more essential than ever before?
Man, it's a great question to mull over, because while algorithms are fantastic at calculating risk segmentation, they are notoriously bad at dragging a title agent to the finish line on a Sunday afternoon.
Very true.
The next time you walk onto a dealership lot to buy a car, take a moment to enjoy that clean, simple transaction. Because when it comes to buying a house, you aren't just buying a product. You are embarking on a deeply human struggle against an invisible machine. Thanks for taking this deep dive with us today.